Good evening and a very warm welcome to this webinar. My name is Wendy Saunders. I'm the International Development Manager here at CABA. During the past year, we've been in close touch with key contacts amongst the ICAEW community in Australia to help us improve our understanding of the support needs amongst the 3,000 plus members and identifying ways CABA can help. We've recently extended the support available in Australia, and if you'd like to know more about our services, please take a few minutes and visit our website. A few months ago, I was invited to join the conference call for the chairs of the Australian City Members Groups, and it was on that call we were asked if CABA could help members understand the recent changes to the UK pension law. We were delighted to try and help. Today's webinar is interactive, and you can ask questions as we go through the webinar by using the Go To Webinar window that you can see on the right-hand side of the screen. After the webinar, you'll be sent a short survey via your email. Please take a few minutes to complete and return it. Your views will help us to continue to improve our services. So, with no further delay, I'm going to hand over to Lee Coles, Head of Workplace Education from Mercer Marsh Benefits UK, so we can start. Thank you, Lee.
Thank you, Wendy. Good evening, everyone. I think probably appropriate for me to start with just some, I suppose, positioning about the process that we're starting today. So it is very much a start, this webinar. There's only a certain amount of detail we can obviously go through. We could spend 10 hours on this particular subject. You'll be glad to hear we're not going to do that today, probably more along the lines of sort of 45 minutes, something along those lines. But the intention is to certainly follow this webinar up. This will be recorded, so you'll be able to review it again. Also, there will be a frequently asked questions document. So yes, I will see the questions that are asked as we go through. I'll be able to answer some for sure, but depending on the level of detail and nature of the questions, we'll be looking to supply a document after that. Also, there will be clinics available, individual clinics, as we understand people will certainly appreciate, hopefully, the information we're giving, but we'll still want to talk about their own circumstances in a little bit more detail, and CABA, again, going to offer that. So a little bit more on the sort of follow-up support, but just wanted to position, again, this is very much a start as opposed to all you're going to get on the subject. We'll talk a little bit now just about what we're going to do and what we're not going to do during the next 45 minutes. I think it would be remiss of us if we didn't talk about the planning process. Wendy mentioned there's a desire to understand some of the changes that are going on, and we'll certainly talk about changes to the UK state pension. We'll talk about pension freedom, which we've been living with in the UK for about 18 months now. And pension freedom basically allows you, if you're over 55, to take your pension and spend it all at once. That's the sort of headline message. It's obviously not as straightforward as that. And I say, I think it's appropriate that we start just to think about how you actually plan, as opposed to think just because I can access money, that means I should. So we'll look at that. We'll certainly cover tax as well. And I suppose the intent, understanding is that majority of Australian residents will stay in Australia, but of course not everybody will. Some will have intentions to return to the UK. Some will end up returning to the UK for family reasons or caring for parents, whatever it may well be. So we're going to try and look as much as we can at both the Australian and the UK positions as far as the tax side of things is concerned. We'll consider pension transfers to Australia, and then some of the key issues to think about before summarising and thinking about next steps. What we're not going to be doing is providing financial advice today. So I won't be telling you on an individual basis what you should or should not be doing. I'll certainly be giving you ideas of things that you should be thinking about when making some of the decisions that you're going to face with your pensions going forward. What I'm not going to be doing is looking beyond pensions or beyond income tax. So appreciate in your planning for the future, there will be other things that you'll need to take into account, but this webinar, as I say, is limited to the subject of pensions and income tax. Also, I won't be obviously telling you how much tax you'll pay. Yes, there will be some facts and figures in here, but clearly how much you're going to pay is very much going to be dependent on your individual circumstances and obviously the governing tax rules, depending on where you're going to end up taking the income. So the planning process, as I say, this world of pension freedom that we've now got basically says you're over 55, do what you like with your pension savings. It is, if you like, a little bit of a devil on the shoulder, encouraging you to spend money that's available and it's yours. You've earned it. Clearly, if we're talking about planning for retirement, just to again start with some essentials. Appreciate you're all very bright people, but let's start with the basics and build from there. What is it that you need to be thinking about when you're planning for your future? I imagine most of you want to stop working at some point in your future, and this perhaps is just one way to just frame your thinking about this. How much are you actually going to need before we start thinking about the pensions and what they're going to provide? How much would you ideally need and want in the first place? This might well help you just to structure your thinking. Survival money is money we're going to need for the rest of our days for as long as we are going to survive, fairly obviously. Safety money, how much is that you're going to need? We're talking about obviously things like emergency funds, insurances, perhaps replacing employee benefits that are no longer with you once you stop working for a certain employer. You're going to have some hours to kill, of course, when you're retired. So freedom money, how much are you actually going to need on the basis that you've got 50, 60 hours a week free that you didn't have to entertain yourself? You'll have potentially children, family members, friends that you want to give money to. And we should also think about dream money. So I suppose the philosophy there is that you have one shot at life, and perhaps you need to spend some time thinking about what you'd really like to do with that future of yours. And you can put some figures here, both in terms of the income you might well need and indeed any lump sums that you might well want. And the clearer you are about the target you've set for yourself, the easier that will tend to make financial planning and financial decisions. So a quick suggestion that might be something you should spend some time thinking about. Now, how to go about planning, I'll touch on this briefly because this is something I see people get, I would argue, wrong, and this is true the world over. Some people, if they're not necessarily taking financial advice, they're planning their own finances, will very much start on the basis of how much they've got. So we've got this, what do I need and want? Some people would just say, well, this is the amount of money I've got from my various sources, and it's more a question of how far you can get. That is not typically the way financial planners would approach planning for your future. They would actually start more with what you want. And then it's a slightly different process, but as I say, a fundamentally different way of looking at the world. How then do you get there? So that would be something I would encourage you to consider. Start more with what you need and want rather than, well, this is the money I've got from various sources. What you tend to do if you go down this is the money I've got from various sources and that's how much therefore I've got to spend, you challenge your spending. That's the one thing that you tend to challenge. I can only spend this much. Whereas if you start with what you want and need and you're thinking about how you're going to get there, you're going to challenge a lot more. So this process, this planning process, very much this idea of what do I need and want versus what I've got, and then you're going to typically end up with either a gap or a surplus. What should you then be challenging thinking about when you've got this gap or surplus? I would suggest there's sort of 6 main areas to consider when planning for your future. As far as certainty of position is concerned, then that is something that again, most people, when they're planning for the future, are they thinking, well, I'm earning this now, broadly I reckon I'll be okay if I've got 80% of that, for argument's sake. Not necessarily true. You may well need a lot more, you may well need a lot less. Have you thought about the tax you'll be paying? Have you thought about the lifestyle that you're going to be leading? Are you actually going to work 2 days a week? Maybe not in the career you've got now, maybe it's a totally different sector, but nevertheless there's still some income in there. So certainty of position is a very important one, and really that's down to you to think about your future and what you want from that. The other sorts of things you should be considering, your working plans. Like I say, is it going to be 5 days a week to 0? Or is that going to be more of a reduction over time? Your spending plans, absolutely. What are you spending now? How much of that is going to continue in the future? How much of that is going to disappear or indeed increase? So give some thought to that. Should you think about using money differently? Is the current format that you've got it in, or how you're expecting to use that money, the right way to do it? We talk a lot in the UK about using property. You know, some people will see property, this is where I live, so therefore I can't use property in plans for the future. You know, not true. And particularly in times of low inflation, property, low interest rates, property prices tend to be higher. Therefore, equity release is something that needs to be given some thought to. You're still able to live in the house you own rent-free, but you'll be able to withdraw money out of it, and all of a sudden you're using that asset differently. It's that sort of thought, the thought process I would encourage you to go through. Could well be that actually you've already got enough, so you need to stop saving. You don't need to save anymore, or indeed, if there is a gap, you do need to look at putting more money into vehicles that will get you where you want to be. Or alternatively, you may well need to get some help or advice. This is obviously a start of that helping process. So hopefully, again, a fairly high-level start, but we wanted to start with the essentials and build from there. And we wanted to make sure that sort of the decisions of taking pensions were put in a context of planning, which is absolutely the way you should look at it. The next subject we'll take a look at is taxation. It's going to certainly be a relevant theme as we go through this webinar. Again, some of this will be familiar to you. I'm sure you're all aware that there is a double taxation convention between the UK and Australia. But it's not exclusively only money that's taxable in Australia. There are a number of circumstances whereby, for example, there is an allowance, a lifetime allowance that you can save or have sort of tax-efficient savings within a UK pension. That's currently £1 million, and if your benefits built up are over £1 million, there is tax to pay to HMRC in the UK before tax in Australia is considered. There are also certain types of pensions. I'm thinking here certainly of those of you who may well have worked for the civil service in the past. Civil service pensions are taxed in the UK. What you're going to get then is credit against tax that's then due in Australia. So to conclude, in the most part, we're talking about money being taxable only in Australia, but that's not exclusively the case. So it's important for you to do some digging for your own circumstances there. On that basis, if you are paying tax on pensions when you access them within the UK, again, many of you will be familiar with this form where you can apply to Her Majesty's Revenue and Customs either to get income in the UK, pension income in the UK taxed with relief at source, so no tax is payable, or indeed you may well be reclaiming tax. And I'll give you an example shortly whereby a pension provider will deduct tax regardless of whether you've actually got a form for tax relief at source or not. So I'll give you a couple of examples there. In terms of the process, this is a document you can go on to Department of Work and Pensions website, Her Majesty's Revenue and Customs website, and get hold of this form. The process is for you to send the form initially to the Australian Taxation Office in the state in which you're resident for them to certify. They will then either forward that on to HMRC, or indeed they'll return it to you for you to forward on. So just in terms of the sort of mechanics of how the taxation and sort of tax relief and getting money paid tax without tax deducted before it comes to Australia, how that works. So conscious that some of you will be returning to the UK to retire. So just to say, bring up to speed as to where UK income tax is. It's also going to be relevant in terms of some of the deductions that may get made, and you'll need to factor into your plans where you're going to be reclaiming that money. But yeah, essentially in the UK, if you're resident in the UK, Personal allowance is £11,000 per annum currently. So the personal allowance is the amount of money you can earn receiving pension income, which is taxable, but it is taxable at a zero rate. So essentially we're talking about tax-free money there. But that's outside of any sort of tax-free lump sum. So it's taxable money, but at a zero rate. The next 32,000 is then taxed at 20%. We've then got a 40% bracket and indeed a 45% bracket for anything above £150,000 in any given tax year. This final point here is something that is certainly you need to be careful of if you are going to return to the UK and be taking large amounts of money, because there is this sort of layer, if you like, between £100,000 and £122,000 where you start to lose your personal allowance. So not only is that £22,000 layer taxed at 40%, effectively you're paying another 20% on tax you would have never have paid tax on. So it's effectively a rate of 60%. So that's something to be watchful of. But those are the tiers in the UK. I'll give you an example then of where you may well not, even if you may well have filled all the relevant paperwork in, you may well still have to go back to HMRC to apply for tax that you shouldn't have paid in the UK. If we've got somebody who's got a pension pot of £30,000 in this example, they're cashing that pot in. So in a world of pension freedom, you're allowed to cash the whole pot in. When I say cash the whole pot in, a quarter of that money is tax-free. So you can see in the first line within the table, tax-free lump is a quarter of that, that's £7,500. No tax is deducted from that. The next £22,500 is taxable, and it will be taxed as though you earn £22,500 a month for this one transaction. So you're seeing 1/12 of 11,000, no tax deducted, 1/12 of 32,000, 20% of that is deducted, 1/12 of the next tier, 40%, so on and so forth. So even though you may well have filled your form in to say, yeah, pay this money over to me and I'll sort out my tax in Australia, your provider may well say, no, that's not how we do it here. We use what's called the emergency month one code rule, and therefore from that £30,000, £8,554 will be deducted. It's not suggesting for a moment that's what you owe, but that will be what is deducted, and it's then for you to go back to HMRC and again go through put the wheels in motion to reclaim that money. How long that will take, again, is going to vary on a case-by-case basis. But it's obviously if you're sort of planning on the assumption that you're going to get £30,000, that's not necessarily the case. So very important that you're engaging with your pension providers to understand how they are likely to tax your money. Now, this concept of emergency month one code is fairly consistent. Normally, the very first payment you receive from a pension, emergency month one code is applied. The pension provider will then go to HMRC to get a tax code for you. Now, if you've gone through the process and filled in the paperwork to make sure that your pension should be taxed with no tax deducted, month two, that will then be corrected. You'll basically have a second or third month where the position is corrected and any tax that's been deducted is repaid, and from there on in it's straightforward. So again, just bear in mind that it may well take month, 2-3 months to actually sort this out when you start making deductions from taxable income from pensions, even though it's not necessarily taxable in the UK. Again, hopefully that's clear enough. Appreciate that we're starting to get into some technical elements here. We'll now move on to state pension changes. What's happening as far as the state pension is concerned. Before we do, I mean, I think it's probably worth just saying, be very, very clear on the type of pensions you've got in the UK. State pension, most people are familiar with the concept there. It's based typically on the national insurance that you've paid while you were working in the UK. You may also have defined benefits, final salary type pension schemes. I know a lot of you may well have worked for the Big Four, who certainly would have offered some form of final salary or defined benefit pension, and that may well be something that you'll be relying on for the future. You may well have defined contribution pots of money. So they are literally just pots as opposed to a defined benefit, which gives you a guaranteed pension or a guaranteed benefit at the end. Defined contributions, much more like a bank account. You've got a pot of money, and it's a question of how you make use of that. We'll obviously go into some detail on that this evening. Very important for you to be clear on the rules relating to each of the pensions that you've got. So that might well be the starting point for your process. Noting down all of the different pensions you've got. Are you clear on what you can do with each? On the understanding that the law of the land may well permit something that your pension scheme, your pension scheme provider, does not permit. It may well be that your pension scheme rules override the law of the land, and you might well need to move your pension elsewhere to get the access that you want. Again, thought that was useful before we go into a little bit more detail as far as the state pension is concerned. State pension age then, my recommendation as far as the state pension is certainly to go onto the Department of Work and Pensions website and get yourself a forecast. As far as state pension age is concerned, yes, this is under review. But basically for anyone who reaches state pension age before April 2028, the new review is unlikely to touch you. That's what we're being told at this date. Never can tell, but that's what we're being promised. So I think for the vast majority of you, your state pension age will stay fixed. State pension is then something that you need to claim rather than it's paid automatically to you. So again, absolutely you'll need to claim that. We've got this new state pension. So the new state pension commenced for anyone who reached their state pension age after April this year. It's £155.65 per week. That's the full new state pension. But the actual amount you can receive might actually be higher or lower than that. It's going to very much depend on your national insurance record. Clearly, some of that is going to be down to time. So how long were you paying national insurance for? We've got a change here, and we've now got a 10-year minimum qualifying period. What we've also got is people will have a national insurance record based on whether they contracted in or out to top up additional state pensions. And again, that we'll spend a little bit of time looking on that next. So yeah, just to reiterate that, 155.65 per week is not the maximum. That is the full new state pension. But if your national insurance record and your contracting in, you paid these additional state pensions have taken you higher than that, then you can receive more than 155.65 per week. If it's lower than 155.65 per week, you can actually build it up, potentially by paying sort of voluntary contributions, but also if you return back to the UK for work. Final point on the slide talks about the triple lock system, which is lovely, but not if you're resident in Australia. I'm sure you're familiar with the fact that your state pension, once it's in receipt, if you're resident in Australia, you do not receive increases. I think there's been a number of political attempts to try and get that changed, so it might well be a cause that you feel you might want to add some weight to, but that's the position as things stand even with the new state pension. Contracting in or contracting out then, I mentioned that. What are we talking about here? So essentially you've had in the old world state pension a basic state pension, which is about £119 if you're already drawing it, and then additional state pension. Started off with pensions, additional state pension before 1978. We then had CERPS introduced in 1978, state earning related pension scheme, and that was when this concept of contracting out was introduced into final salary or defined benefit pension schemes. That was extended in 1988 to defined contribution schemes. So what we're talking about here is, do you have some of your national insurance going off to the government to get you additional state pension, or is it going into your company pension or a private pension to give you an alternative benefit? And the silver line there is intended to represent potentially someone's career. They could well have been say working in the UK, contracted in, as say, initially everybody was until 1978. They then join a defined benefit pension scheme, which it means they're contracted out and are no longer building up additional state pension. They then leave that employment and they're contracted back in. They then move to another employment or decide to contract into a personal pension. And again, everybody now is effectively contracted in that's still paying national insurance within the UK. Hopefully that makes sense. It's a tricky concept, but the idea is you may well have had periods while you worked in the UK where you were contracted in, building up additional state pension, contracted out, not building up additional state pension. Why it's important for me to make sure you're understanding this. When you do get your state pension forecast, or indeed start receiving your state pension, there will be an amount mentioned on that document, a contracted out pension equivalent. So it will say, well, had you have been contracted in throughout your entire working life, we'd give you £130 a week. However, you spent 10 years where you weren't contracted in, so your contracted out pension equivalent is £20, and we're going to give you 110. The idea being that £20 would come from additional sources, be it a private pension or indeed a final salary defined benefit type pension. Again, hopefully that makes sense. Fire questions in as and when you need to. But as I say, my absolute tip would certainly be, first and foremost, get yourself a state pension forecast to confirm what you're likely to receive. Not had any questions on that so far, so we'll move on to the topic of pension freedom. So pension freedom, essentially introduced in April 2015, relates to defined contribution pension pots, so pots of money as opposed to defined benefit plans. It's not to say that defined benefit plans haven't been impacted, and I'll move on to talk about how those have been impacted shortly, but the essential rules are around defined contribution pension pots. And that says if you are age 55, you can take your pension, a quarter of it tax-free, the remainder as whenever you like and however you like. It's not quite as simple as that. Firstly, this goes back to what I was saying about pension schemes not necessarily playing ball. Your pension scheme providers are not obliged to offer any of the freedoms that I'm about to talk to you about. What they are obliged to do is typically they're going to offer you some form of transfer. You can move to another pension provider who will offer you that flexibility. Potentially that's going to be in the UK. Obviously it may well be into a plan in Australia, which we'll touch on later. So yes, you've got freedom, but it may well mean that you'll need to undertake a transaction first before you can access that freedom. This point is more relevant for people who are intending to return to the UK, carry on working and pay money into pensions. If you do use any of these new flexibilities, that is to say, take taxable money, it's not the tax-free money, because that's not a new flexibility. The ability to just take your tax-free lump sum and not touch the rest of your pot has been around for a while. It's new flexibilities where you're actually taking some of the taxable money, would reduce the amount you can pay into a pension based on earnings, maximum of 40 down to 10,000. Again, I won't say too much on that, but it's certainly relevant if you are intending to return to the UK and work. So those are the sort of high-level points as far as pension freedom concerned. When pension freedom was announced, the suggestion was that everyone was going to get free advice on their choices. The government stepped back slightly on that, and it's free information. Nevertheless, the service they've set up pension-wise, it's a free impartial service, and you can get access to guidance about your options online, over the phone, and face-to-face. They won't tell you what to do. So again, it's not advice, but it is nevertheless a useful service for you to access. So I think, again, going back to the planning process side of things, before you think about accessing your pension, very much important for you to have in mind what your income and capital needs are. I would also think the timing side of things is important. When do you want to take your benefits? I would very much start with that before thinking about exactly how I'm going to access my pensions. And as I said before, then start thinking about the type of pensions you have and the choices you have for each. Is there a sensible process for you to access different pensions at different times, for argument's sake? Is there one that there's merit in accessing one pension first before you access another? You don't obviously have to access all your pensions all at the same time. So do give some thought to that. I think I would also say that there are 5 key things that are important, and again, true around the world, I would suggest. When when it comes to the pension choices you're going to make, ask yourself this: do you want something which is going to provide you with certainty or flexibility? Do I want a guaranteed pension that's going to come into my bank account every month and I can absolutely rely on it, and it doesn't matter if I live to 130, the money is still going to be paid? Or do I want something which is flexible? Actually, I envisage myself spending lots more money in my 60s to 70s and then less beyond that. So I actually want the choice as to how much money I'm going to take and spend and when. Tax is obviously going to be important. We've already highlighted that, so be clear on the tax implications of your choices. The longevity question is an important thing for you to consider. Are your savings going to last as long as you do? The money needs to, not in every set of circumstances, need to last as long as you do, and it may well be you've got a pension pot in the UK and that's your 60 to 62 money, and once you get to 62 you've got plans elsewhere. So ask yourself that: how long has the money got to last for each of the different pensions that you've got? How is your money going to be invested? This is a point that again, we're seeing a lot of changes in the UK. And for those of you who are still in touch with your pension providers, you may well be receiving some correspondence about that, a bit more detail on that. But again, an important consideration. Have you got a decision to make about how that money is invested? And I suppose my one deliberate mistake, if you like, in the presentation, the last point, what happens if you were to die, almost suggests you've got a choice in the matter. Probably should be what happens when you die, but never quite had the heart to change that line. But you take the point. 5 things for you to think about, which may well give you a lot of direction as to what the most appropriate pension choice is for you. Hopefully that's useful again. Defined benefit pensions, I suggested there is an impact as far as pension freedom is concerned. A little bit of information to start with just as a refresher on defined benefit pensions. Typically what you've got, you will have had a length of service, a length of membership that you were in that defined benefit pension scheme. You would multiply that by an accrual rate, so typically a 60th or an 80th, and then there'll be a salary definition, which will start with the salary that you had when you left membership, but typically that will be revalued up to the point at which you take your benefits. Typical calculation might well be someone spent 20 years with one of the big 4 in a 60th pension scheme. Their revalued salary is £30,000, so the pension payable would be £10,000 per annum. That's broadly speaking how defined benefit pensions work. Things for you to consider when it comes to taking those defined benefit pensions. I would say there's 3 main choices for you to consider. Firstly is when. When do you access this money? And the point I want to make there is that I don't think the language used is particularly helpful. What I mean is if you take it at your normal retirement age, that's absolutely fine. However, if you want to take the money earlier, you'll often receive what's called a reduction. If you actually delay taking it before your normal retirement age, you receive an enhancement. Now, if you just take those 2 words in isolation, I'd much rather have an enhancement than a reduction. What you must remember, of course, is that you're getting that money earlier. So let's say it was a pension of £10,000 a year, and let's say I took it 2 years early. Yes, I may well receive a reduction of £1,000. On that £10,000. So all of a sudden it's a £9,000 pension. But I'm getting that for 2 years before that £1,000 deduction comes into play. So I'm £18,000 at least in front before that £1,000 deduction applies. Then of course depends on how long you live. If you only live another 10 years, you're better off. So don't just be swayed by that. Think more about how much am I going to get in any given year, and when is it right for me to take it. Don't be swayed by those words reduction and enhancement. Another decision you'll have to make, not in all cases, sometimes you'll get a sort of a mandatory tax-free lump sum, but often you'll be given an option as to whether or not you take a tax-free lump sum, and it's a question that comes up a lot in sort of workplace education. What sort of things should you be thinking about here? How much are they actually asking you to give up? Normally you'll have to give up some pension before you get your tax-free lump sum. A lot of the sort of civil service public sectors are a typical factor might be something like 12. So you give up £1 a pension, you get £12 of tax-free lump sum. A generous employer might well be closer to £20, and it's a lot easier then to make the decision. If I was giving up £10,000 of pension for a £200,000 lump sum, that feels a lot easier than giving up £10,000 of pension for a £100,000 lump sum, for argument's sake. Health is going to come into the equation as well. If you're likely to live a long and happy life, you may well feel you're better off with more guaranteed income. If you've got a need for tax-free lump sums, if you want to make sure there's money there to give away to loved ones potentially if something happens to you, say perhaps you're again, you don't have a spouse, so spouse's benefit is no good to you, in which case a tax-free lump sum might make perfect sense. So there's some choices for you to make there. Where pension freedom comes into it, and understand that a lot of you may well have worked in private industry in the UK. You're likely to have this right of what's called a cash equivalent transfer value. So this is saying, do you know what? Yes, you owe me £10,000 per annum at age 65. Forget you owe me that. Give me the lump of money that you've got set aside to provide that, and I'll sort myself out. And now that would be a move from a defined benefit pension into a defined contribution pension. And if we're talking £10,000 per annum, you might well be looking at something like £300,000 to sort yourself out with. Now the government had, when they introduced pension freedom, considered banning this, but they didn't think they could, and in certain circumstances clearly it's going to make sense for you to actually take the 300,000. If you've got 5 years to live, for argument's sake, do you want £10,000 per annum or £300,000? It's a fairly obvious point to make. However, the one thing that they did in terms of sort of consumer protection, if you like, if you do want to transfer your defined benefit plan to a defined contribution plan, you have to take financial advice, and it has to be a UK Financial Conduct Authority regulated advisor who can give you that advice. Typically something you're going to have to pay for, not your old employer. That's not true if the actual pot that's required to provide your pension is below £30,000. So if you were only with an employer for a short while, for argument's sake, then you can take the money, 25% tax-free, the rest taxable, with no advice required. Should also add that pension scheme trustees have new powers where they can say, do you know what, we're not offering a cash equivalent transfer value at the moment, or yes, we probably should offer you 300,000, but because of the funding of our scheme, we can only offer you £200,000. And then you've got a separate question to ask. So I'm going to talk a little bit more about the advice related to this particular subject, because there is a consultation going on at the moment. But moving on to what your DC pot could provide, essentially you can do this in part or in whole. 4 things: tax-free lump sum only, encashment, cashing the whole thing in, which Department of Work and Pensions in their wisdom have decided to call uncrystallised fund pension lump sum, UF+, so you may well come across that. Flexible access, it's also known as drawdown, where you're taking the money as and when you want it, or indeed traditional annuity purchase, which I would imagine a lot of you are familiar with, where effectively you're exchanging your pension pot for a guaranteed income for life. We'll have a quick run through of each of those. We've got Dave here. Dave's got a pension pot of £100,000, and he's wondering, should I just take the £25,000 tax-free to clear the mortgage? We've set it up in a UK example rather than further complicate it by trying to then explain what happens if he then tries to move the money to Australia, just for the sake of simplicity of explaining the concept. So absolutely, he is free if he wants to take that £25,000, clear his mortgage, and all of a sudden he's £448 a month better off. Does he actually end up better off in retirement? Clearly, it very much depends on what he does with that £448. If he spends it, essentially he's just put a hole in his pension pot. If he saves that £448, yes, there is a possibility. But this is where we have to sort of slightly move away from our emotional brain, which might well tell us paying off the mortgage is always the right thing to do, to our logical, factual brain. A lot of you will be relying on to say, well, actually, am I going to be financially in a better position? So yes, it's an option, but do ask yourself, are you taking it because it's the right thing to do or because you can? What if you cashed in the whole pension pot? So that's £75,000 that's taxable. We've got Dave here working in the UK, earning a salary of 30,000. 3,800 would be his normal tax bill. But because he's cashing in this £75,000, his tax bill is now 105,000. Sorry, the taxable income is £105,000, and his tax bill from being 3,800 is now 32,200. I say most big pension pots you'd probably not want to cash in all at the same time for that reason, but nevertheless it is an option that is open to you. It might well be the only option your provider offers, but do remember you can move it to somewhere else. We've got Mike here, scenario 2, who's going to take the pot gradually. He's 60, had enough of work, finished. State pension is not going to kick in for another 6 years, so he's got this pension pot of 100,000 and he is taking just 14,000 out, a quarter of which is tax-free. The rest is taxable. He didn't need to do that. He could have just taken 14,000 out as part of his tax-free lump sum, but he's not. He's taken out some tax-free, the rest taxable. The reason being, by doing it this way, the taxable part of his income is under the 11,000 personal allowance limit I described before. Therefore, he wouldn't pay a penny in tax on that £14,000. Also, point I'd like to make around the change of how when you die, pensions are taxed in the UK now. Let's say Mike died after year 1. That £86,000 that's remaining, that would be available tax-free outside of his estate to his loved ones. If he was over 75 when he died, that's the only point at which it becomes taxable as far as UK law is concerned now. So again, just make sure you're clear what happens when you die as far as pension benefits are concerned, but that's a fairly significant change. Contracts, here we're talking about this sort of flexible access drawdown contract. Again, the idea is you can take as much money as you like, when you like, but it's your responsibility to make sure that lasts. And here what we've got Mike doing is, let's say, keeping that 14,000 a year for the next 6 years until his state pension kicks in, and he won't have paid a penny of tax as far as the UK position is concerned. Obviously what that isn't is a sustainable thing that he can do for the rest of his life. So the longevity question, no, you're not going to be able to take £14,000 out of a £100,000 pot and it lasts for the rest of your days. So you're going to need a plan B there, evidencing the point, the need to think about longevity. If you are concerned about longevity, a guaranteed income for life would be, an annuity would be the way to go. We've got Sarah here. She's trying to generate £2,000 a year of inflation-proofed income. She's a smoker. She's diabetic. If we look at the different rates that she could get, without sort of looking at the fact that she's a smoker and she's diabetic, the maximum pension she could get for £50,000 is about £2,700, £2,800 a year, but that is a level pension. So inflation is going to eat into that. If you want something which is inflation-proof, escalating in line with the retail prices index, you can see a fairly significant drop to the legal and general pension offered of about 40%. So not great returns for that money. But again, I suppose the benefit being if Sarah lives to 130, legal and general will have to keep paying regardless of RPI or indeed what the original amount invested was. As far as annuity purchase is concerned, lots of bells and whistles you can add in. 5-year guarantee periods, 10-year guarantee periods. However, the more bells and whistles you put on, joint life 50%, 100%, so the amount of income you are going to receive is lower. However, Sarah is thinking about an annuity and in fact gets the amount of income she wants because she's a smoker and because she's diabetic. So it is, as again I'm sure you're aware, insurance companies will pay you more money if they think you're going to die sooner. So idea is try and look like you're going to die tomorrow and live for another 30 years. Difficult one to achieve, but nevertheless that's the way to play annuities if possible. So quick summary then, main 3 options other than taking your tax-free cash: an annuity which gives you the certainty, drawdown which gives you the flexibility, full cash withdrawal or UF+, but be careful on the taxation side of things. You always need to think about tax, but just some ideas there around say what you might need to think about with each of those 3 options, assuming you're going to take the money in a UK format. Did say that you'll be getting quite a lot of information potentially from pension providers at the moment if you've got defined contribution pots relating to your investment position prior to taking benefits. Again, I'm not going to labour on this and appreciate you're going to have this recorded, but the thing to get your head around is the reason why you potentially need to look at how your money is invested is depending on which of those options you are going to choose or you've got in mind to choose, there are different risks applying to each, and therefore you would want to invest your money in a different way. So someone who at 55 is intending to cash the money in would arguably have different risks to cover someone who is actually going to intend to keep their pension invested until they're 80. It may sound obvious, but as I say, a lot of the pension schemes out there, the default investment fund that they put people into assumes you will buy an annuity, whereas most people won't. So just make sure you're clear on that investment side of things. So look, a number of tasks for your sort of pension to-do list. Be clear on the type that you've got. Do get your up-to-date projections. No point in getting a projection telling you what you're going to get at 65 if you've got no intention of taking that money at 65. Number of things to think about in terms of flexibility, certainty, tax efficiency, all the things I've mentioned so far. That lifestyle option is the investment piece that I talked about for those of you with defined contribution pensions. What about transferring either to another UK provider or indeed to Australia? And again, many of you will be familiar with this concept that you need to have for a transfer to be valid. You need to move it to a qualifying recognised overseas pension scheme, or QROPS. Slightly unusual system this. HMRC will not guarantee at the point at which you take out a QROPS that it's a valid QROPS. So basically you need to make sure that your provider, if you're going to go this route, is legitimate. You've obviously, in the most part, you'd want to take financial advice. May well be that you have to take financial advice, particularly if you're trying to secure safeguarded benefits like the defined benefit pension transfers we were talking about before. There is a list of qualifying recognised overseas pension schemes, but it's for that pension scheme provider to tell HMRC that they meet the criteria. HMRC don't actually check whether they meet the criteria until you move your money into that plan. If you get it wrong, penalties are severe, 55% UK tax penalty, regardless of anything you might well need to pay in Australia. So can't overstate the need for sort of due diligence on the type of advice you're getting here, the type of pension provider that you're going to be selecting if you are thinking about transferring. Now, what we have got at the moment, and this is literally started at the end of September, so a couple of weeks this has been going, there's a consultation that the UK Department for Work and Pensions is started about the advice requirement relating to overseas pension transfers. There is a recognition that it's fairly tough. So if we picture someone in Australia who's got a defined benefit plan, wants to access money, they've got to get advice from an FCA regulated UK advisor who may well be nervous talking about the fact that you've then got to move the money to Australia and QROPS. So yes, there are providers out there who will be able to advise the whole end-to-end process, but they are few and far between, and they're going to be pretty busy. So the question is, should there be some relaxing of the rules? And I would suggest chartered accountants living in Australia with a vested interest, UK pension scheme members as well, your voice would be taken into consideration. I think at the moment the government is very much erring on the side of caution and on consumer protection, and they will stay put. But as I say, you will find it fairly tricky and potentially having to pay two lots of advice and doing due diligence on two lots of advice to actually get that sort of transfer effected. So that's one for you to watch out for. Things to think about then, again, a summary. Clearly residency status is going to be important. Again, you'll be familiar with the law on residency and temporary residency, so I won't say too much about that, but obviously think about where you're likely to be taking your pension before you access them. Do think about your wider savings and assets. Have you got property you're going to take into account, other savings, and is there a sensible way that you can manage your cash flow involving any UK pension savings? I've only touched on income tax today. Clearly there are capital gains, inheritance tax, other factors that you'll need to give some thought to. Is your product and provider the right one? Whether that's changing within an alternative UK provider or indeed potentially moving to a QROPS provider. And as far as any further questions are concerned, we've had one or two which I'm sort of conscious I've run over time anyway, so I'll apologies for that, but you will get those questions answered within the frequently asked questions document. Again, I'm sure there is a facility for you to keep feeding those questions back in once the webinar has finished, as and when they occur to you. When the recorded version of the webinar comes up, do keep feeding those questions in. Do think about whether or not you'd actually want an individual clinic to actually talk to someone in the UK about your pension options. May well be that you want to wait until the frequently asked questions document comes out, but if it's more of a, just talking through some of this stuff on a one-to-one basis, again, that is free and available as a CABA member. Do you need financial advice is another question. Again, not something that CABA are going to provide, but again, if you sort of want some help sourcing financial advisors or indeed any subject relating to this particular issue, and indeed the issue of being resident overseas but having potentially family or savings in the UK, do feed that back to CABA. I think they're absolutely open to running different webinars of this type. This was very much a first up attempt, so hopefully we've done a good job for you. But again, very much keen to get your feedback and your questions so we can make sure everybody's happy. With that, I'll leave you, hand you back to Wendy to wrap up. Hopefully that's been useful for you all.
Thank you so much, Lee, for such a comprehensive webinar. You have covered an enormous amount in the time that we've had available today. I do hope that you found that helpful. As Lee said at the beginning of this webinar, we do appreciate this is a very detailed subject, and we are just making the beginnings of trying to help and support and advise you. So we will be taking the questions that have been posted and that will be posted over the next week, and Lee will be producing an FAQ document that we will circulate to everyone who's been on the webinar today. So hopefully that will be helpful as well. We are also offering a free and totally confidential consultation with Lee. It will be up to about 30 minutes where you'll be able to ask more individual and detailed questions. If you would like to take advantage of that, please can we ask that you email the address that's coming up on the slide. It's the australia@caba.org.uk email, so we can then put you in touch with Lee. And please can we ask that you do that by the 25th of November. You will also be receiving a very short evaluation survey, and please can we ask that you just take a few minutes, and it will just take a few minutes, to give us your thoughts about how helpful this survey has been so that we continue to improve the services that we offer.
Wendy, I will just say, just to, I suppose, manage expectations around the one-to-one consultations. So my area of expertise is very much the UK. Obviously, I do have some understanding of the process for Australia, but if it's obviously detailed HMRC type questions, sure, or Australian Tax Office questions, I'm unlikely to be able to talk too intelligently about that. But certainly around the sort of UK workings of how the pensions industry operates, that I certainly can talk people through. I think that's probably worth just saying.
Yeah, thank you. Thanks for that, Lee. And finally, thank you for joining us today. If you'd like to know more about CABA's work and how we support members in Australia, please take a minute to visit our website, caba.org.uk/Australia, and you'll find further details there. My contact details are on the bottom of the slide. My email is there. If you have any thoughts or ideas about what more we could do to support you and your families, please drop me an email. I'd be delighted to hear from you. So thank you again for joining us. I hope you found it helpful. Thank you. Bye-bye.